A farmer in Brazil sells soybeans to China. The contract isn't in Brazilian real. It isn't in Chinese yuan. It's in US dollars. A European airline buys oil from the Middle East. Not in euros, not in reals, dollars. A government in Africa borrows to build roads. The debt? Priced in dollars. Stop for a second. Why does the world, 7 continents, nearly 200 countries, rely on the currency of one nation? And more importantly, what does that give that nation in return? Right now, this question matters more than it has in decades. Sanctions are reshaping geopolitics. Trade wars are escalating. Countries are openly discussing alternatives to the dollar. Central banks are stockpiling gold. New digital payment systems are emerging. The phrase de-dollarization is no longer fringe. But before we talk about whether the dollar's throne is shaking, we need to understand how it was built. Let's rewind. World War II isn't over yet, but the outcome is becoming clear. In a small town in New Hampshire, representatives from 44 nations gather to redesign the global financial system. The United States holds most of the world's gold. Its factories are intact. Its economy is dominant. The agreement they reach becomes known as Bretton Woods. Here was the deal. The US dollar would be convertible to gold at a fixed rate. Other currencies would peg themselves to the dollar. In simple terms, the dollar became the anchor. If you trusted gold, you trusted the dollar. And if you trusted the dollar, you trusted the system. For nearly 3 decades, this arrangement defined global finance. Then, in 1971, it broke. America had printed more dollars than it had gold to back them. Foreign governments began demanding gold in exchange. The math didn't work. So President Nixon ended dollar convertibility. The gold link was cut. The world expected chaos. Instead, something surprising happened. The dollar kept its throne. Why? Because by then, the dollar was no longer just tied to gold. It was tied to something more powerful: oil. In the 1970s, the United States reached agreements with major oil-producing nations. Oil would be priced in dollars. In return, those nations would invest surplus dollars back into U.S. financial markets. This created a feedback loop. If you needed oil, and every industrial nation did, you needed dollars. To get dollars, you exported goods to the United States, or you borrowed them in global markets. Either way, demand for dollars remained strong. Gold was no longer the anchor. Energy was, and with it, global trade. But oil alone doesn't explain it. The real foundation of dollar dominance is deeper. It's liquidity. The United States has the largest, deepest, most liquid financial markets in the world. U.S. Treasury bonds are considered among the safest and most easily tradable assets on Earth. If you're a central bank managing hundreds of billions in reserves, you need somewhere to park that money. You need scale, stability, and the ability to sell instantly if needed. Markets provide that. No other country offers the same combination at the same magnitude. Not Europe, not China, not anyone. Trust compounds. And over decades, that trust becomes infrastructure. Today, roughly 60% of global foreign exchange reserves are held in dollars. A significant share of global trade is invoiced in dollars, even when the United States isn't directly involved. International loans, often denominated in dollars. This creates a system where the dollar isn't just America's currency. It's the world's operating system. Now here's where the power becomes visible. If the world needs your currency, you can borrow in your own currency. Most countries cannot. If Brazil borrows in dollars and its currency weakens, its debt becomes more expensive. If Turkey borrows in dollars and the dollar strengthens, pressure builds. But the United States borrows in dollars it can create. That's an extraordinary privilege. Economists call it exorbitant privilege. It means the U.S. can run trade deficits for decades, import more than it exports, spend more than it taxes, and finance those gaps by issuing debt the world eagerly buys. Imagine running up a credit card bill, and the rest of the world competing to lend you more. That's the dollar system. But privileges come with consequences. Because so much global debt is denominated in dollars, when the Federal Reserve raises interest rates, the shock waves are global. Higher U.S. rates strengthen the dollar. A stronger dollar makes dollar-denominated debt more expensive abroad. Capital flows back toward U.S. assets. Emerging markets feel the squeeze. Currencies weaken. Debt burdens rise. Financial crises ignite. The Fed sets policy for domestic reasons, but its decisions ripple worldwide. No election abroad influences that vote. Yet entire economies adjust to it. Publicly, the dollar is described as stable, reliable, a safe haven, and compared to alternatives, it often is. But underneath that stability is leverage. Sanctions provide a clear example. Because global payments flow through dollar-based systems, access can be restricted. Banks can be cut off. Countries can be isolated from the financial grid. It's not just military power, it's monetary infrastructure. Control the rails, and you influence who can move. Now zoom out. Why doesn't another currency simply replace the dollar? The euro is large, but Europe lacks a single unified fiscal authority. China's economy is massive, but its capital controls limit free movement of money. Gold doesn't scale easily in a digital world. Cryptocurrencies are volatile and fragmented. To dethrone the dollar, you need more than size. You need open markets, rule of law, military protection of trade routes, political stability, deep bond markets, global trust. That combination is rare, and trust, once embedded, is hard to displace. Still, cracks appear. Countries are experimenting with bilateral trade in local currencies. Central banks are increasing gold reserves. New payment systems are being built outside traditional Western channels. None of this has ended dollar dominance, but it signals hedging, insurance against overdependence. Here's the uncomfortable math. As long as the dollar remains dominant, the United States must supply the world with dollars. How? By running deficits. If America stopped importing more than it exports, if it stopped sending dollars abroad, global liquidity would tighten. The system relies on imbalance. The U.S. consumes. The world produces. Dollars circulate. Treasuries are purchased. The cycle continues. It's stable until it isn't, because dominance can breed complacency. High debt levels, political polarization, rising interest costs. Strategic rivals building alternatives. Reserve currency status isn't a law of physics. It's a position earned and maintained through credibility. Lose credibility, and trust erodes slowly. Then suddenly, history offers perspective. Before the dollar, the British pound held global reserve status. London was the center of finance. Britain dominated trade routes. Its currency was trusted. 2 world wars, economic strain, shifting power dynamics. Gradually, the throne passed, not overnight, but decisively. So where does that leave us? The dollar remains dominant. U.S. markets remain deep. There is no immediate successor waiting in the wings, but structural pressures are building. A more multipolar world, fragmented trade alliances, digital currencies issued by central banks, strategic competition between major powers. The question is not whether the dollar collapses tomorrow. It's whether its share slowly declines, whether parallel systems grow alongside it, whether dominance becomes influence instead of control. Because the dollar's throne isn't just about currency. It's about who sets the rules, who absorbs global savings, who exports financial shocks, who can finance deficits without immediate punishment. It's about leverage disguised as liquidity. The world depends on one nation's currency because history, scale, trust, and power converged in one place. That convergence built a system so large that exiting it is costly for everyone, including the United States. And that's the final tension. The same structure that grants extraordinary privilege also binds its issuer to global stability. If the dollar falters, the world feels it. But if the world fragments, the dollar's reach narrows. So as nations explore alternatives, as alliances shift, as debt piles higher, one quiet question hangs over the global economy. Is the dollar's throne permanent, or is it simply the current chapter in a much longer story of monetary power?